Foued. All right, so your question. I noticed the protective put loses most extrinsic value when stock tanks and the spreads, bid-ask spread, become very bad. Okay. Yes, that's with every option. Call or put, doesn't matter. If the call shoots up quickly, it's going to lose all extrinsic value. It's going to become all intrinsic value as it goes deeper and deeper in the money. Same thing with the put option. You're getting closer and closer to that maximum risk. Oh, I did close it. Man, that was mean of me. I apologize. So, perfect example of this, and it was actually hard, but I did manage to close it. Let me re-enter something here. You're not seeing what I'm doing, I know. I'm pausing the screen for a moment. I had just cleaned out the Charles Schwab position that I closed on the 14th, I believe. Yeah, the 14th. And let's see here. Before, let's see, I had a cost basis. Oh, okay, I'm sorry. Let me go back. I'm looking at the trade briefs here in the few. I'll show you. It doesn't mean I don't need to show. There we go. Okay, so I did the 9 when it was at 77.42. Initial cost basis was 82.04, and I think I had lowered that to 82. No, I'm sorry. It was 82. I lowered it to 80. That's what I meant. I lowered it by 2. I lowered it to 80 something. I sold to close the 85, put it 870, and bought this at 565. Okay, but the original purchase price was $675, so I made $2 on that. So I think it was down to $78 with the 80 put for 565. That sounds about right. Let's check it out. Right, I'm not going to no, I am going to enter the married put. We're going to enter the married put. Doesn't matter the date, but I think before I did this, I could probably check it on the closed position here on the portfolio, but somewhere around 314, what I say, about 78.60. Let's just use 78.60 per share. We bought the June, rolled down to the June. Sorry, folks, let me view all options here. All right, 80 for 565. So we'll also put that just around 314. Okay, so let's take a look at the profit and loss chart. Okay, the maximum risk was 5% on the position. The June option is still 91 days away. This was closed on the 14th. The day I just put in as an example Foued is the day that I canceled it. You're absolutely right. Because as the stock is going further and further down in price, naturally Schwab got hit with the SIVB, SVB situation, the bank situation, and everything along those lines. What's happening? Well, my put, when the stock was, roughly around 77, my put was slightly in the money, so it had a good mix of extrinsic and intrinsic. But when the stock fell, it's just going deeper and deeper in the money. As you go deeper and deeper in the money in a call or a put, what's happening? You're just at intrinsic value. And that's exactly what was happening here. You can see it on the graph. Even, that's looking at the halfway point. But even if I just put tomorrow or Monday, my apologies, you still see that curved red line. We're right near the maximum loss. Yes, the time value goes away quickly when you have this much of a decline. We're talking 30, 40% at one point. When I closed the position in Fusion, the stock was down almost 31%. It had been as low as 38% decline. It had hit 50. I think it dropped below 40. I'm sorry, below 50. I think it hit 49 on one of those days. And it rallied back up. And I just said, there's no way in 90 days this is going to come back to where I need it to at 80. Some things are possible, but not likely. Just liquidated the position. What did I have, Foued? I had the 80 strike put for June, 90 days away. Stock's at 56.79, and we sold the put, got filled at 23.45. It was about 20 cents over intrinsic value. That's it. That's the only extrinsic value remaining was 20 cents for 90 days because it's so deep in the money. You look at any current option chain. Did we have an option chain up? No, we didn't. Okay. So let's just go to Apple, for example. And again, doesn't matter if it's call or puts, but when you get that rapid decline, even, and this wasn't one that declined, of course, but just as you know, as you go deeper and deeper in the money, what we talk about, where is my column? There it is, ask time value. So right now, with Apple around the 150 strike, a 10% move would put us at 135. Okay, that's perfectly fine. 20% drop, like we saw with some of the big bank stocks and some of the big moves that you're talking about, would put us down to 120. Now, this still has 1.7% of time premium, but you can see it's just getting closer and closer to the 1 range and 0 range the more steep the decline is. Schwab was more noticeable because it was half the price, right? It was a $77 stock opposed to a $150 stock. So when it took that 20-25% drop in 3 days, it just went almost straight to intrinsic value. Personally, I think I was lucky to get 20, 25 cents, 24 cents, whatever it was of extrinsic value when I got the fill price that I did. That's the expectation. And again, this is one of the reasons why in the blueprint and in other lessons, we talk about the catastrophe report. Using the profit and loss chart on power options is what we're referring to as the catastrophe report. I want to say, hey, if my stock does fall X percent, how much am I expecting to lose? If it falls in the first 10 days by 10%, how much am I giving up on the put? This is giving you a good estimation. This red curved line here, it's what the value would be using the Black-Scholes theoretical pricing model. But as you can see, as we got closer and closer, whether it's 1 day away, whether it was the halfway point between now and expiration, we're still pretty much close to that maximum loss on the trade. Now, I think the maximum loss I could have taken on the Schwab position was 7.1% or 7%, and we got out at 6.1% loss only. So I was kind of happy with that, with the stock being down 31% and as much as I think close to 40% at one time during that trade. I don't like to lose, but I'm not going to stay in this position. I'm not going to roll down the put again and go to a potential 18 or 20% loss with things as they are right now. This was a good trade that we had bulletproof. Oh, no, sorry, we did not have it bulletproof. My apologies. That was NEM. This was a good trade that we had. We made some good profits on initially. Black Swan, unexpected event, hit the banking circuits. It triggered this. The chart. Let's take a look. You can see it. There it is. Yeah, it dropped all the way down at one point to about 45, closed at 52 though. That's just what happened. Now remember, I'm holding the 80 put and I just took my risk back up. I moved it down from 85 to here around this time frame because I thought it was bottoming. And then the news came out. I don't want to move back down to this range with the put. I drastically lower my cost basis. It would drastically lower my break even. But if this type of fluctuation continues and it moves further down, now I'm going to be at a 16, 18, 22% potential loss. I don't want to take that. I'm going to take my 6% loss on this trade and move on from the position. That's what we did. We liquidated that in the Fusion portfolio. Opened a new one today on AMD. And of course, we also allowed the ANET position to be assigned. And we've got the NEM position that had a nice 4 or 5% run up today. A lot of the gold and silver stocks did as well. So that's just where that is. But that's the expectation that you're going to see happen in those cases as well. So Shishir says, let me take a look at EOG. Shishir is in a put position or a married put position in EOG. And I just want to go to the chain. I'm sorry. I was trying to think of where I wanted to go. I want to go to the chain first here. And Shishir asks, since IV has gone up recently with the recent bank issues and things of that nature, is it a good idea to roll the put down? Have EOG June 114 now prices 104. Should I roll down June to May? Whatever. Okay. Well, I don't know your exact position, but following the rules in the blueprint, you know when we prefer to use that structure. I'm not using it. I can't tell you what to do. Okay? I cannot give you direct advice. What I can tell you is that I did a couple of income method number 9s recently. Now, let's see. Let's just go 1 month. No, I'm going to go a target day. I'm going to go target days. So oh shoot, do I still have it up here? Yeah, when did I do that 9? 3-3, right? Yeah, 3-3. Okay, so that's when I did the 9. Nah, I lost it. Okay. So let's do a custom time frame. I just want to go 2, 1. I guess I got to call it 2 months. Let me do 2 months here. It's not showing it as well as I'd like to. So I'm sorry, guys. I'm trying to show this, and I'm not sure if it's going to show up the same way I want to see it. Let's go from 2/25, 2023 to, what is that, 3/5, 3/4. Okay, sorry about that. Yeah, it's harder to see here, but what I look for typically when I do income method number 9 is, you see, the MACD was declining and declining. I'm looking for it to show me something along this line, that it's stabilizing and starting to curve back up, hopefully pointing me to there's a bottom of the position. Now, Schwab did. It wasn't the right move to do. Hindsight 2020. I should have just stayed in the position where I had it. I'm sorry, where I had it and not done that income method number 9 and taken the risk back up to about 7%. Yeah, lowering the risk to about 6.9% there. Because of the massive collapse in that situation. Couldn't see it. It was more of a black swan event. It was kind of in the news a little bit. There were some warning signs that it was doing it, but right before all of that stress banking came out, the Schwab chart was showing me exactly what I wanted as far as what I look for with an income method number 9. And let's look at other examples. So what I mean by that, and I can't highlight it real well, is, okay, so here is a downturn, but when it starts here and it looks like it's going to start moving back up, that's when I might consider it. It was starting to flatten this decline that it had from a few days ago, and I thought now would be a good time to lower here. And then, of course, then the news came out, and 2 days later, and it was over. So in that case, we look at it in those situations, okay? All right. Let me see. What is my other example? Anna is probably a better chart to look at, even though I think I don't even remember if I did not use income method number 9 on Annette, I don't think. But I had opportunities to, but it moved so fast. So yeah, you can see right there, this little downturn blip it had, when it starts to show sort of a leveling and it's getting near back where you start to see the MACD sort of stabilize and almost start to move back up. Hopefully it's picking a bottom. It's an indicator. If you think you're at the bottom, that's the best time to use income method number 9. Okay, if your technicals, whatever you use, if you use stochastics, if you use other things, if you follow RSI, if whatever you use is showing you that you're pretty close to your bottom, or you think a bottom is being hit, that's the best time to use it. The income method number 9 you're talking about, Shishir. So EOG, I'm not sure if that's the exact signals I would use. You might be using different signals. You probably know the stock better than I do because you've been in it for a while. So I'm seeing this still moving. I'm not seeing what I'd consider stabilization. Yes, you get false signals, absolutely. But that's just like any indicator. And that also depends on news that comes out. See, here, looks like it would have been a good time to use income method number 9, because then the stock rallied back up. But now we're back down again, unfortunately. And so I'm trying to see, yeah, that's the downturn. So it started to stabilize and move back up. I'm not seeing that yet here. Doesn't mean it's not a good time to do it if you're comfortable with the risk. You're going to lower your break even. You're going to lower your cost basis on the position. You're going to put yourself primed to be able to get back to break even faster, but you're going to increase that risk. And if you haven't hit the bottom yet, you might start seeing more losses on the portfolio, even though they're not realized, than you would have had initially with the Mary put. So that's the balance you've got to consider.